Federal Reserve's media mouthpiece Nick Tamirose, aka Nikki Leaks, recently published an article on Wall Street Journal regarding what the interest rate cut decision is going to be for the FOMC meeting in September, which is going to be published on the 18th of September. And he's saying that in an article that the Federal Reserve will cut for sure, but now the debate is whether it's a 0.25 or 0.5% rate cut. In the article, is saying officials are weighing the risks between inflation and labor market softening, and recent inflation data shows moderation in inflation, while the job report data is mixed. One thing not to be overlooked is that the revision of the job data both on annual basis and on the monthly basis, because they're revisioning downwards, meaning that whatever we had before, which appears to be okay, is no longer that okay because they're revisioning downwards, right? So a smaller 0.25% rate cut would be in line with Federal Reserve's usual incremental approach. It avoids signaling economic alarm because they're so used to 0.25 steps. If you go bigger, it's telling the market that you're worried about something, right? And that's not what they want. And a larger 0.5% cut would be seen as a insurance against the economic slowdown, but might lead to expectations of faster rate cuts in the future meetings. Okay, it's maybe telling the public that this time is a 50 basis point cut, next one will have to be 50 basis point cut. It's giving people that impression. And it could also trigger unnecessary market rallies or indicate economic weakness, okay? Especially right now, the market's pretty much at all-time high. Is it really what the Federal Reserve want to pump up the market even further upwards? And before the article was published, the market was pricing in a probability of 85% chance of a 0.25% rate cut in September. But after the publication of the article, as of today, September 14th, the market is expecting a 50-50 situation where there's 50% chance of a 50 basis point cut in September and a 50% chance of a 25 basis point cut September. So just based on this observation, based on what's actually happening, it seems like to me that Federal Reserve is using a Nick's communication strategy to prepare the market for a more realistic probability, because obviously 85% chance of a 25 basis point rate cut is not realistic. And right now, this is more realistic, okay, a 50-50 probability, because this, as a result, won't cause as much of a panic if the Fed do cut by 50 basis point, because now the public is prepared. They have been warned. And I personally think another thing that wasn't mentioned in this article is China, the China situation, right? It's the factory of the world. If you look at China, the real estate market has been going down. That means the spending within the country is kind of weak. So as a result, the output of the country, right, the products that's being made, they're getting exported more because internally the consumers are getting weak, okay? And as more goods produced by China are exported, and they're pretty cheap, fairly cheap, it's going to be deflationary for the world, right? This isn't captured in the article, but I think this is worth mentioning. It's a deflationary pressure for the U.S. market, meaning that most likely, right, the narrative of that of the fact that the inflation is behind us, that narrative is most likely true. But the question is, for us retail investors, what's the implications? How should we react to this either 25 or 50 basis point cut? I think either way, it doesn't matter. It shouldn't affect the retail investor that much. I think it's important for the retail investor to keep your risk exposure at a level where it's acceptable for you and your situation, okay? Because you just have to keep in mind, right? There's always risks associated with stock market investing or trading. It's a game of risk and reward, because the stock market is only rewarding because it has risks. If it doesn't have risks, you can just buy the bonds or just put it in the savings account. You don't get as much rewards. Okay, the rewards and risks, they come together bundled. I personally think, of course, it depends on your situation. I believe that doing extreme moves in the market investing is very undesirable. For example, I see people commenting about selling everything or buying with all their cash, right? All in or all out. I think this kind of extreme movements are undesirable for retail investors. According to the research from Bank of America, as you can see on this screen I'm showing you right now, post 2013, okay, and 2013 is over here. Post 2013, the Federal Reserve, or in this chart they're calling it central banks, they have repeatedly intervened even in minor shocks in the stock market, and this phenomenon is actually, or this behavior of the central bank is teaching the investors to buying the dips, okay, buying the dips, and it's telling the investor buying the dips are the source of alpha, okay, or they're pretty much saying you could be beating the market by buying the dips. And in this chart, the blue color text represent self-fulfilling dip buying. The green color represents successful verbal or policy intervention driving equity higher, and the orange color represent fading impact of Federal Reserve, or central bank intervention, and the red color represent central bank intervention fail to stop equity decline. And the red color only happened once, which is over here. It's the COVID-19 decline. Even though they're calling it a failure, I don't think so, okay? It's once in a 100-year black swan event, and it only caused the shock for 1 month because of how quickly the amount of QE that was happening during that month, okay? They pumped the market back up within a month. It's a V-shaped recovery. I don't think that's a failure at all. So pretty much saying buying the dip has been a pretty successful strategy, okay? And also the research from Goldman Sachs is reflecting the same phenomenon. This chart is showing us that the bear markets and corrections has been less frequent since 1990, okay, 1990s. In the chart, the blue light color represents 5% drawdown, and the dark blue represent 10% drawdowns. The orange represent 20% drawdowns. And as you can see, the frequency here, right? As we get more closer to today's day and age, the frequency of these drawdowns, it's very obvious. Lots of white gaps. I mean, the frequencies are a lot less and a lot less severe because of a more active central bank we have intervening or deploying so-called Fed puts. Okay, and that's all I want to share with you today. What do you guys think? What's going to happen in the September 18th FOMC meeting? Do you think the Fed is going to do a 25 basis point or a 50% basis point cut? Let me know in the comment section below. Please don't forget to like and subscribe. I upload similar contents very regularly on this channel. Thank you. Bye.